So I want to take this opportunity to welcome you to our introductory class for public finance and taxation. My name is Daniel Mutiso. I normally teach CPA online classes. Normally also teach students NCCA and also CIFA. Now, some of the units which I normally cover, we have financial management at your level. I know now that you are doing intermediate level. I normally do financial management, management accounting, and public finance and taxation. Um, then when you go to advanced levels, I normally do advanced financial management, advanced taxation, and then we also have advanced management accounting. So let me take this opportunity, and I hope you will be able to enjoy these sessions as we continue, or I continue taking you through. When you look at the aspect of the public finance and taxation, it is normally classified into two. We normally have the areas of public finance, and then also which normally comprises of introduction to public financial management, relationship between the national and county governments on budget and economic matters, the oversight function in public finance management, procurement in public entities. We normally also have public-private partnerships arrangements. I know that that is some of the information which you can be able to get from the domain, right? We normally also have public debt management. Then that is the area of public finance, and I have a PDF which is well elaborated, and I will be able to share in our WhatsApp group. Now, when you look on the areas of taxation, and I know very well that we are always, or we are checking on the current matters which are happening on the environment of taxation today. Don't forget that we have to be embracing the concepts of the Finance Bill 24. So in this case, we are going to be looking on the definition of tax, the taxation, and the types of taxes in Kenya. What is the some of the history of taxation? What are some of the classification of taxes? Bearing in mind, we have tax shifting. We have and factors that determine the tax shifting. The tax shifting is about shifting the burden, whether it is to the consumer or to the supplier. Normally depends whether it is forward or backward shiftings. Those are well elaborated with the document which I will be able to share with you. Then we have some of the principles of an optimal tax systems. Types of tax systems, we normally have single versus multiple tax systems. Purposes of taxation and why the government normally tours or normally wants to levy taxes. What are some of the tax evasion? What is the meaning of the tax evasion compared to the tax avoidance? And between the two, which is one is legal and which one is illegal? We normally talk about the taxable capability within certain jurisdictions, the budgetary and physical policies, and then the last thing there, which you have to be checking on, should be the revenue authority structure, functions, large and medium taxpayers of fifth mandate. And that is why we normally discuss about giving people, there are people who qualify, normally qualify for the TOT, that is the turnover taxes. We have some thresholds which these taxpayers need to meet. Those are some of the requirements in which the taxpayers need to meet, which are being put there by the Finance Act. Now, when you look on the aspect of the medium and large enterprises, there are those companies which normally qualify for the VAT. Now, the VAT normally also have some of the requirements which are basically given there. and it is very crucial for you guys to monitor the developments which are being proposed by the Finance and Government and Finance Committee, which is going to be bringing to us the finance bill. Uh, they are just talking about the finance bill which we are having is about the proposals. But when you look at it, most of the proposals which most of the proposals which we are able to see today, basically when they go and vote, those are the outcomes which we are going to wait and see. Now, we also have the taxation of income, right? And in this case, I just want to look on the we just need to look on the basis of charging taxes in Kenya, Section 3 of the Income Tax Act, the concept of residency and criteria of taxing income in Kenya. We have taxable and non-taxable persons, specified sources of income, incomes which are normally exempted from taxation. Najua vizuri sana mnakumbuka the people with disabilities, they have some caps which are normally exempted from taxation. We shall be able to look at it, and most probably we will be able to elaborate much about that when we are looking on the taxation of employment income. So what is an employment income and how is it going to be benefiting you as an employee? Or what are the requirements as an employer, and what are you supposed to be doing? So these questions we will be able to answer them because this is the first topic which I just want to start with. The other topics which I have discussed, they are theoretical questions, and I will be able to share that document with you. That document which I'll be able to share with you will be assisting you to go through the theory parts. Once you go through the theory part, it means that we will be able to check on it during our revision and looking on the areas of concern during that period. But for now, it is well for us to understand the aspects of the computation because the areas of taxation which we are going to be checking on will always be in an exam. So there is nothing we can be able to avoid in such cases. Now, when you look on the taxation of the when you look on the taxation of employment income here, when you look on the taxation of employment income, you see that when you're looking on the employment income, we are saying it is a relationship which is existing between the employer and the employee, where the a minute, please. Hello. So let me continue from where I stopped. We were discussing about the employment income, the employment income, and I was able to elaborate, or I was just saying that unemployment is just a relationship which exists between the employer and the employee, where we are saying that the employer later provides services for consideration. When we look on the definition of an employer, we are saying it includes it normally includes any person having control payment of remuneration. This may be an agent, a manager, or other representatives in Kenya for any person who is outside Kenya. Now, what about the employee? We say an employee just any holder of an appointment of office, whether public or private, or a calling for which remuneration is going to be paid. And I know very well that in today's market, when we are applying for these jobs, we are saying that how we normally look at the what is going to be benefiting us as employees. And in this case, that is where we are looking at the gains and profit that we are going to be getting from the employment. We are saying that when you look on the employee benefits, they are normally the direct or indirect compensation that employees get apart from the regular the remuneration, which is basically called the employee benefits, and those are the things that we are looking at. So the employee benefits in Kenya, it normally includes things like healthcare insurance, dental insurance, paid leaves. We normally discuss about the sick leaves, vacation leaves, childcare benefits, maternity leaves, and retirement plans, among other benefits which we will be able to discuss here. Sometimes it normally makes employee feel secure and confident. It normally makes employee feel secure and confident about the organization they are working on. So by offering good employee benefits, employers normally or can also minimize the employee turnover. You know that, eh? But when you look on the aspects of the compensation laws in Kenya, you are going to be finding that the Kenyan Employment Act is going to be providing the fundamental rights for every labor and employee. A glimpse of what it normally discusses, it normally discusses about the rights to fair labor practices under the Article 41. We normally discuss about the protection from slavery, servitude, and forced labor under the Article 30. We normally discuss about the protection of wages, right? Rights and duties in employment, termination and dismissal rules. That is when Patanga, an employee who has not be given any warning. There is no warning, number one. There is no any termination letters which are coming from the after the warnings. They normally deny to sign. And that is why we are saying we need to have the termination and dismissal rules, which are going to be guiding us as an organization in regards to how are you supposed to be terminating the contract of an employee. What is the prohibition of child labor? You remember that there are those organizations which they like to make or to use children who they don't know their rights to work for them. So the minimum wages also they normally vary with the employment type, industry, you know that, industry, working time, and locations. When it comes to compensations, you are going to be finding that the person, for example, a teacher who is working at Mandera, is having some benefits which we can be able to talk about, allowance benefits and so on, compared to a person who is working in Nairobi. The differences normally varies. And the minimum workers' compensation in Kenya would normally start from 13,572.90 per month. That is as per the revision which was done in 2022. So when you look on the revised act, part 5, the rights and duties in employment, which normally ensures fair working hours, annual leaves, maternity leave, sick leave, housing, water, food, and medical attention for employees during the employment. And these are the things that I'm just elaborating so that the moment we are going to be doing the questions, you will be able to understand as to why we are factoring. Why am I saying that a specific benefit which is being derived or which is coming from the employer should be capped or should be given to an employee when you are calculating those benefits. Now, apart from the Employment Act, you normally find that under the Labor Institution Act 2007, Wages Council and National Labor Board take care of remuneration and other employment-related issues. So the occupational safety under the act, yeah, these are the acts which you can just be able to look on them when you Google. So don't mind where I'm getting them because I'm used to teach them. So you normally find that under the Occupational Safety and Health Act 2007, normally provide the safety and welfare for employees and of person at the workplace. And in this case, we normally talk about the other aspect we can be able to look, which normally guides the employees, the Employment and Labor Relations Court Act 2011, which normally take care about that no employee feels unheard and solves employment-related disputes according to Article 162, subsection 2. So when you look on those things, which already are existing in which are basically existing there in the internet. You will be able to check on them and repeat and learn about them through the internet. They are there. And that is why I'm saying when you're studying the taxes, we need to be checking on the things which are happening today. If you can be able to agree with me, the videos which we did for the previous period, for example, in 2024 April exams, now based on the changes which we have on the rates and so on, those videos might someone if is going to be watching them, unaweza pata you will be able to fail the exams because of the different rates, because of the changes which we are experiencing now. Now, when you look on the mandatory benefits employers offered in Kenya, you'll be able to understand that some of the mandatory benefits which we normally take from the employers. Number one, they are the annual leaves. And if you're working to an organization which does not guarantee that, then remember there is a risk which is basically involved in long run. Even you are an accountant there, you don't give or you're not advising your directors about these benefits which are supposed to be granted to employees. At the end of the day, if these charges are coming by your side, then you'll be able to find that an employer will say, I don't have any knowledge regarding the employment, you see. And I have a professional here who was able to employ this person, and he has not been able to advise me. So it is very important for you to advise your employers regarding to the annual leaves, pensions, those are the retirement benefits, national holidays, allow the employees to work, to stay at home. And if they have to work, it is very important for you to compensate them based on the rates that's agreeable by the organizations. We have the maternity leave for female employees. We normally have paternity leave for male employees. We normally have things like NHIF and NSF deductions and benefits. We normally discuss about some of the details about the leaves. We normally have to grant someone 21 annual leaves in a year, 3 months paid maternity leaves for female employees, 2 weeks paid paternity leaves for male employees, 7 days paid leaves in a year, 10 national holidays in a year. Some of the medical benefits, and which you know very well, and we are going to be learning about them, they are basically capped. And for example, when you look on the employer shall ensure that the provision of proper medicine for employees during the illness. These normally include the self-inflicted injuries. We're also talking about injuries or illness that happen when an employee was on leave without intimation, and illness that are covered under the insurance or for the illness-free treatment, which are basically provided by the government. So some of the employee benefits in Kenya for expatriates, right? These are the people who are coming. Because these are the things that I just want to expand the amount about. The expatriates, these are the people they are normally professionals, who are from other countries, right? And we need them. We need to take them to our country specifically to come and serve a specific purpose or a specific duty. And the reason is why they are in Kenya to serve a specific employer. It is not they are coming here to check me and then they go and check another employer. Apana, they are here to serve specific employee. Now, when you look on the how the employee benefits they are normally taxed. We have talked about the aspects, for example, the employee benefits, which are basically taxed in Kenya. You'll be able to find there is the profit, which we are going to be getting from wages, salary, leave pay, sick pay, fees, commissions, bonuses, gratuity, traveling, and other allowances that employees will be able to receive for the rendering services. And you are going to be basically checking on when you look on as an employer, you have to register under payee, right? And I have been able to see that there are accountants who are operating companies. That company does not have a liability or does not have statutory deduction for payee. They don't have they don't remit the deduction to the revenue authority. They don't have that obligation actually for payee. That is very dangerous for the organization. Organization will find it normal report a turnover per month of around 5 million, but it doesn't have a payee, doesn't have NHIF, doesn't have anything NSSF. Those are some of the risk things which can expose the organization which you are working on. The employers have to deduct it based on the prevailing rates. For example, when you look on the NSSF, how we are computing now, we are talking about the first seven, then the balance. We are going to be, it is going to be subjected for the 6% of that gross amount. You see that, I know that you are aware of that. When you look on the things like NHIF, we have some of the graduated credit provided there. We are looking on when are they supposed to be remitted? We are talking about 9th of the following month. So in this case, these are the things that we have to be checking on. As we continue to check on the gains and profits from the employment, the things that we're going to be checking here, they are the aspect of the vehicle or car benefits, provision of housing, loan at interest rates, which are normally lower than the market rates provided to the employees, housing facilities such as water, electricity, telephone, securities, and other expenses, which are over 3,000 per month. Pension contribution paid by a tax-exempt employer to an registered plan over 20,000, that is equivalent to 240,000 per annum. Pension contribution paid by the employer to registered pension scheme, equivalent to 240 per year. Then we have to be looking on the employee income that are not chargeable under payee. That are the medical cover by the employer, pension contribution paid by the tax exempt, pension contribution regarding to, these are the things that I will be able to show you. But we are going to be writing those notes. You see, there are benefits that you know that they are not taxable. But those benefits, when you put them in writing in an exam, you get a mark. You need to know that. I will just be able to highlight those things when we are doing our illustrations there. Now, let me look at something small here regarding to the gains and profits from employment. Number one, we are looking on the non-cash benefits, and these non-cash benefits, we are talking about. These are the benefits or advantages of facilities of whatever nature, right? Um, that arise by virtue of one's employment. They normally include the benefits in kind, right? We are saying these may include, um, this might be including that gifts, meals, and awards, etc. The benefits are taxable if the aggregate amount, right? If the aggregate amount value is more than 4,000 per month or 48,000 per annum. Now, number two, we are discussing about the servants provided by the employer, and we are saying these are the servants. For example, we have drivers, house servants, security guards, etc. The taxable benefits is higher of the cost incurred by the employer and the market value for such servants. Now, we have things, for example, like we have things like the services provided by the employer. For example, there are those people who are benefiting from the telephone, electricity, water, and furnitures, etc. Such benefits will be taxable on the basis of the higher of. And for example, don't forget on the current proposals of the Income Tax Act. You remember now we were discussing about, let me just check on some of the proposal here. We were looking on because here, when we are checking on it, we are discussing about, when you're looking at it here, we are saying that the cost incurred by the employer on the telephone, electricity, water, and furniture, the cost incurred by the employer, and the quantified benefitables provided by the revenue authority. And that is why they are providing us with some caps. They are talking about more than 3,000 above, right? They are giving some limits. But for the furniture, the taxable benefit shall be 1% of the cost of the furniture per month, or 12% on the cost of the furniture per annum. For telephone, we are saying the taxable benefit shall be 30%. But this one might be affected by the current changes which we are experiencing here. We were being told what now? There was around there are some of the things which you need to check on. For example, when you look on that Finance Act now, right? Just looking on the those most so that I can be able to update your video with, for example, here we are saying just 1 minute, 1 minute. Just want to look at that so that tutaruka, for example, notes where they okay. Now you remember the proposed Finance Act 2024. Talks about it normally talks about the excise on telephone and internet data services increased from 15% to 20%. The excise on money transfer services by banks, money transfer agencies, and other financial services providers increased by 20%. Excise duty on the fee charged for money transfer services by secular phone services providers increased by to 20%. Then excise duty on betting is back to 20%. Those are some of the changes which we might be experiencing when the Finance Act is passed by the Parliament. Do you think they will be able to deny it? Just say no. They cannot be able to deny anything as long as they are being given the kickbacks. Now, when you look on the motor vehicles now, and these have been the discussion in town, this is where a vehicle is owned by the employer, and we are saying, but it is used by the employee for the private purposes. The taxable benefit depends on the cost of the vehicle and the engine capacity, right? That is, we normally discuss about the CC ratings. I know we are aware of that. Where the vehicle has been leased from a third party, the cost of leasing the vehicle shall be the taxable benefit. Where the vehicle is owned by the employer, we are saying the taxable benefit is higher of one. We talk about the 2% of the cost of the vehicle per month, that is equivalent to 24% per annum, or we are discussing about the CC ratings provided by the commissioner. But when you discuss about the aspects of the motor vehicles now, when you look on the issues of the motor vehicle, the revenue authority or the proposals of this bill, they are saying under the finance bill, the vehicle owners to pay a new annual motor vehicle tax at the rate of 2.5% of the value of the car. This, the minimum is 5,000 and the maximum will be 100,000. We will be able to check on those developments, but this will not be able to affect these changes of the Finance Act cannot affect your exams. Now, when you look on the housing benefit, we are being told this is when an employee is housed by the employer in a house, either owned by the employer or the employer has leased the house and pays rent directly on account of the house occupied by the employee. And we are saying that the employees can be categorized as number one. We normally discuss about the agricultural employee, and this is an employee who is required by the terms and the conditions of the employment to reside in an agricultural farm. Now, the house shall be 10% of the employment incomes, where we are going to be lessing the nominal rent. But when we talk about the employment incomes, we have to be checking on which normally comprises of the employment income. We'll be able to check on those areas when we are doing our illustrations. Number B, we are looking on the ordinary employees and full-time service directors. And our full-time service director is an employee who dedicates service substantially the whole of his time to the service of the employer in managerial technical capacity and does not own or control directly or indirectly 5% or more of the share capacity capital of the company. So the housing benefit shall be the higher of number one. We normally talk about the 15% of all the employment benefits. We lay the nominal rent. Second, we are looking at the market rent of values of the premises. We lay the nominal rent. Number C, which we are calling non-full-time directors, and the benefit shall be the higher of, these are the people who they don't stay at the companies, but they normally come in, wanakuza and they leave. They come and they leave, but they are not staying there. Now, when you look on that benefit, you're going to be checking on what is the market rent of value of the premise. Then we let the nominal rent. The nominal is what you're going to be contributing, right? The 15% that is a beneficiary. Now, the 15% of the total income will let the nominal rent. Now, what are some of the exemptions in the housing benefits? We are saying there are certain instances that would provide for a strong case for employees not to be taxed on the housing benefits provided by the employer. And these exemptions normally applies to, we are saying, number one, where the house is provided the basis of the effective performance of the duties of the employee. Those are the key areas we have to be checking. They are the reasons, by the way. Number two, where the housing is a necessity to the employee proximity to the workstation, e.g., we are looking on the hospital employees. These are the nurses and doctors. Then number three, where the house is provided. Sorry for that. Where the house is provided as part of the security details. We have to be checking on that. Where the questions Swali zimedraftiwa from where? Then we have to be checking on those areas. As the question we are doing is it for the nurse? Is it exempted from taxation or for the benefit computations or not? Now, when you look on the non-taxable benefit from employment, number one, we talk about the passages for expatriate employees. And when you discuss about the expatriate employee, a passage is an expenditure on transport and translocation between Kenya and any other place outside Kenya. And we are saying that it is normally incurred by the employer for the expatriate employee and his family members. So the passage shall not be taxable subject to the following. Now, the first thing here, you just need to understand what is a passage, right? What is a passage? And we have said a passage is just an expenditure, which is normally incurred by the employer to transport and translocate the employee, who is an expatriate, right? It should be an expatriate there between Kenya and between Kenya and other places outside Kenya or between other countries, right? Um, for the expatriate and his family members, but for the person shall not be taxable subject to the following, right? A person must not be a Kenyan citizen, right? I will not be able to, I'm not expecting, for example, Eric aniambie, mwalimu, I qualify for the passage because I'm traveling from Nairobi to Mombasa for the 44th summit. We cannot be able to pay for that. That is not, for example, I just be giving an example. You are traveling from Nairobi to Tana County, and then you say you need a passage. No, that person should be not be a citizen here. The employee must have been recruited or engaged from outside Kenya. Those are the requirements. The employee must be in Kenya only for the purpose of serving the employer. And that is why I said you're not coming to Kenya to serve EABL and Coca-Cola. No, you have to serve EABL. They take you back. If Coca-Cola wants you, they will be able to pay for you to come here, right? But now it is not that another company will be able to ask you to come. And then once you are in the country, and you start working for other companies. No, that concept you need to understand it. Then we are saying the amount must be used for translocation between Kenya and the other country. Now, those are the requirements for the passage. Number two, which is an untaxable benefit, we are saying This is where the employer provides a medical care to the employees. Where the medical scheme covers all the employees, the benefit is not taxable, right? This is what we normally discuss about non-discriminatory. And we are saying where the scheme covers only some employees, that is discriminatory scheme. The benefit is taxable. But if, for example, it covers some, right? If it covers some, that is discriminatory. It is for the specific people. But if it is for the entire organization, it is not a taxable benefit. But if it covers the managers, for example, if it covers the finance department, that is discriminatory. And therefore, it is a taxable benefit. And for the full-time directors, non-full-time directors, the medical benefit of up to 1 million per annum is not taxable. We shall be able to see what happens, for example, if for example the employee was able to incur, for example, 3 million, and then the employer was able to compensate on that, it means the 2 million is a taxable benefit. Now, number three, we are looking at the benefit in kind. Benefit in kind. Benefits in kind, where the value is less than 3,000, right? The benefits in kind, where the values are less than 3,000 per month, or we are talking about 36,000 per annum. Those are some of the things you need to check, which are capped there. And you know that we have said a benefit in kind is just an uncashed benefit for of monetary value that you provide for your employees. So these benefits can also be referred to as notional pay, and which basically we can talk about the fringe benefits, or sometimes they are normally called pegs. And the benefits are the monetary value, so they must be treated as taxable in. And that is why we are saying we have to be looking on that, by the way. The benefit in kind there. Let me just be specific. I'm just checking whether we have any changes there. So that mm, so still we have just confirming something here. Where we have been told the own and cash benefits are taxed at the higher of the actual cost of the employer, and the market value, for example, water, electricity, domestic help, watchman, radio, alarms, etc. Provision of furniture value benefits of 1% of the cost of the furniture to the employer. Telephone, which are landline and mobile. We are not choosing whether you are using the type of the phone, will be 30% of the total bills, right? Um, there is another thing there which we have to be checking. When you look on the fringe benefits, we are saying the taxable value of the benefit is the difference between the actual interest charged and the commissioner's prescribed rates published on a quarterly basis. So the fringe benefit tax is due and payable on or before 9th of the following month and is paid together with the pay as you earn. That is the aspects um, of the fringe benefits. And when you look at it, you're saying it normally arises where the employee is granted what? Is normally granted a loan. It normally is granted a loan by the employer at the rate which is lower than the market rates. And we are saying that the employer is required to pay the fringe benefit tax on or before. I have already stated that earlier on. So to calculate it, for example, if we are discussing about a loan, we are discussing now about a loan. It means that we are going to be taking the market rate minus the actual rates. Then we multiply by 30%, which you know it might be a corporate tax rate. Number five, we are discussing about the employer's contribution on behalf of the employee to a registered pension scheme or provident fund. And this question normally comes in your exams, and you need to be very keen about how you're handling it. There is an aspect of the question normally says that Motito was able to pay 10%, right? 10% of his gross salary towards a registered pension scheme. whereas the employer was able to contribute similar amount, right? It means when I'm calculating my employment benefit, I just go there and I talk about the employer contribution towards the pension scheme. I put a hyphen there and I say it is not taxable, right? And I put that there at the end. It means I will be able to get a mark to determine that. I will be able to get a mark on that. So you need to be very keen on how you handle the questions. Now, the other thing is about the school fees. We are looking on the school fees and we are saying this is the school fees paid on behalf of the employees, as long as it is basically treated as an unallowable expense in the computation of the taxable profits by the employer. The school fees paid for the children of the employees, right? As long as it is basically treated as an unallowable expense. But when you look at it, you'll be able to find that Daniel Mutiso was able to pay school fees for the children of, for example, Alex, right? For the Alex was able to pay, and then if they are telling you it was used as an allowable expense in the computation of the taxable profit by the employer. Now, when those terms are basically used, it means it means that it is going to be a taxable benefit if it was used as an allowable expense. But if it was used as an allowable expense, it means it is not a taxable benefit. Now, um, I was looking on these aspects. We are looking on the education fees of employees, dependents, or relatives borne by the employer, are taxed on the employee unless the employer disallows the related cost for corporate tax purposes. And that is what we are discussing there. I will just be able to share some of the improvements which are being discussed. So you can have more knowledge regarding to the employment, so that when you are doing the questions over the Sunday, you are not floating, you know what we shall be discussing. Number 7, we are discussing about the meals provided by the employer to the low income employees. These are the employees whose taxable income is not subject to tax rates of more than 20%. And that is why we have to be checking on the graduated scale rates, right? And we look on the rates. What are the rates what is the percentage rate for the taxing of these kind of employees? Because when you are talking about the tax rate, we have to be looking on the salary which is you have computed. Is it being taxed by 2015 or 25%? 25 20%, that is the case. Now, number 8, we are discussing about the education fees paid by the educational institutions for low-income employee dependents attending the institutions. And I know these are the key things which you are finding in most institutions, whereby you find that there is an employee who is a cleaner, right? Anafanya cleaning yake pale, and then at the end of the day, shule imemprovidea a room for reading, for certain course yenye anatake. Those ones we are saying they are not a taxable benefit, and that is why we are saying it is being placed there for non-taxable benefits. I'll just be able to share those notes with you. And then number 9, it is a third of employment income of non-citizen or resident employees of a non-resident company trading for profit, which is approved by the commissioner, and the employee is absent from Kenya for 123 days or more in a year of income and his employment income is not deductible while ascertaining the employer's taxable income. I will check on the question regarding that for better understanding. Number 10, we are saying the first 150,000 per month paid to disabled persons who are registered with the National Council for Persons with Disabilities and approved by the commissioner. I remember now we are looking on per diem. When you look on per diem, Eric, who unapewa ngapi per diem when you are going to the field there? How much is the organization giving you per diem? Eric, how much is your per diem based on your organization? How much to
2,000.
pay? 2,000. I'm paying 3,000. You're not given 2,000. Who is
Yeah,
given
3,000.
3,000? 3,000. The organization which can pay 3,000, yes. So out of station allowance or per diem of up to 2,000. So what happens if I'm given 5,000? What normally happens if I'm being given 5,000 shillings? It means that the first 2,000 will be exempted and the taxable benefit will be 3,000, right? Now, the other thing is that allowable deductions. Allowable, we are discussing about benefits and non-taxable benefits. What are some of the deductions? And I know that right now we are computing the income tax individual, for example. So there are benefits we have which you have gathered during the year. Which are the items which will be reducing that income, right? And that is where we are telling the people invest on the insurance companies. Invest because they are going to be giving you some reliefs and so on, right? So some of the allowable deductions we are saying, number one is the employee contribution to register pension and provident fund. The deductible amount shall be lesser. Remember the upper part now. On the benefits, we normally take the higher values. When it comes to the deductions, we take the lower. So that is where we are going to be looking on the lesser or the lower of. So in this case, we normally compare between the three and we take the lower values. One, we normally look on the employee's actual contribution, that percent of the pensionable income. Number three, we talk about the maximum limit, which is 240 per annum. And if, for example, the employee was employed during the year, you prorate the amount. This doesn't mean that it is two. That is why we are reducing it to months, right? We are dividing it up to months, so that we can be able to know kama huyo employee alifanya for 8 months, what will be the maximum limit for that. Number two, we are talking about the registered home ownership saving plan contribution. And it is where an employee makes a deposit against his employment income in respect of a fund in approved institutions. Such amount shall qualify as a deduction. The main objective of it is to ensure that the employees make savings for securing a residence at a future date. This is what the government should be emphasizing on the employees. This one, you see this, right? And we have already said here, right? The maximum allowable deduction is 8,000 at the maximum per month or 96,000 per year. And the registered institutions basically they normally include the building societies registered under the Building Societies Act, insurance companies registered under the Insurance Companies Act, and then you have the banking institutions registered under the Banking Act. For example, you'll be able to find that we are now struggling to pay the housing levies. But do you think in the future you'll be able, or the government will be able to give you a house? I think we will wait and see. We'll wait and see what will happen. Now, the other thing is NSSF contribution. You know nowadays on the NSSF contribution we are doing 3%, 1.5, 1.5 for employee and employer. Then number four, we are discussing about the owner-occupier mortgage interest, and we are saying this is the interest paid by a person on amount borrowed from specified financial institutions. The amount must have been borrowed to finance purchase of premises for residential purpose, improvement or renovation of premises for residential purposes. So the maximum deductible interest shall be 12,500 or 150,000 per annum. Number five, we talk about, and this is very common now to us, we are talking about the amounts of contribution by the employee to a professional institute or body, which is related to his employment at, for example, we are giving an example for like IcePack. What are some of the reliefs which you can be able to get there? The release will normally reduce the tax liability, and I was able to state this earlier. So there are two types of reliefs. They might not be two. Now, in this case, number one, we have the personal relief. And we normally look at the personal relief is minimal. From April 2020, the relief is capped at 28,800 per annum or 2,400 per month. And we are saying where an employee has more than one employer, they are entitled to claim personal leave credit through only one employer. So what about the insurance relief now? And when you look on the insurance relief, which is granted in respect of residential individuals who pays premiums for. So in this case, we can say a resident individual shall be entitled to insurance relief at a rate of 15%. I know you know that of the insurance premium paid, subject to a maximum relief of 5,000 per month or 60,000 per annum, provided the individual can prove that they have paid premiums for life insurance for themselves, their spouses, or their children, and that the insurance secures a capital sum payable in Kenya and in Kenyan currency. Their employer has paid premiums for the benefit of that individual that has been charged to tax on that employee, or both the employee and the employer have paid the premiums. Correct. Now, uh, for example, we have some issues there. Effective 1st January 2024, my document is over now. Effective 2024, the resident individuals making contribution to a post-retirement medical fund will be entitled to an additional tax relief, in addition to the reliefs already provided for the Under Income Tax Act, including personal leave and insurance reliefs. And the amount of post-retirement medical fund relief will still remain as 15% of the amount of the contribution paid, or 60,000 shillings per annum, whichever will be lower. Whichever will be lower. Those are some of the things which you know, or which you need to know. I will be able to share this site for better understanding. You'll keep on updating yourself. So that is a bit of introduction. And these are the things that already you know. These are the things that you know very well. Those notes will be assisting you. They will be assisting you to do what? To do your questions. To do your questions. So they will be assisting you. So in that case, it is very important for you to go through them. Once you go through them, you will be able to understand that when you are meeting on Sunday, we are meeting on Sunday, we are going to be doing our computations for employment income. And we'll be able to start with the December. Is it December now? It is April 2024, running backward. Running backward, and we see how we can be able and how we can be able to understand the concepts of the employment income, right? Now, when we come out of that, we'll be able to look at the taxation of the investment income later on. If the time will allow, I will be able to do it. The taxation of the investment income, we normally invest on two things here. We invest on, we normally invest on what? We do investments in order to get dividends and interest. How are they being taxed? We shall be able to know during that period. From there now we have to be checking on the how do we normally tax partnerships, right? What is the taxation of partnerships? What is the taxation of the business income, right? We have some business incomes. How are they basically being taxed and so on and so forth? So those analyses I will just be able to share with you. Will be able to share with you. I think if we can stop at that point and agree we meet on Sunday, I think we will be satisfied with that. Unless there is any question or suggestion, please. Any?